This meeting is being recorded.
All right, so initially I wanted to present long-short investing and what I've learned. But I thought about like what's the real essence of what I've learned and like diving really deep into this. And this is what I present today. So it's relevant for you for long investing, for short investing, for all kind of asset valuation and profiting from the market. Title is Profit from the Market Pulse. So you will learn what the market pulse is. And you see it already in the subtitle. It's about understanding valuation ranges to gain an unfair advantage. Some of the things we will discuss today, like you might have seen before, but you will see them a little bit in the new context and how to actually make money with it and how significant this is. Like most of the stuff here I have from this German hedge fund manager. Like I did a course from him on long short investing and then dove deeper into different books and courses and other content. So let's start. Basic concept is that the world we live in works in ranges, right? I mean, we know that most things in life aren't flat, they somehow fluctuate. And we have that in like biological things like our heart rate or dopamine level. We also have it in our breathing rate, whatever. If you run, we have a different breathing rate than if you rest. We have it in sunshine hours and like all kinds of different things, right? Like, and you, for example, have a table with maximum and target heart rate. Like it varies on age and activity, but essentially there's a certain range, which if you're like 20 or 30 years old, you're probably around that, yeah, with a relatively higher probability. And yeah, that is essentially how the world works. So that's nothing new, but it's the basic premise that I want to present today. Why is this important? Why do ranges play any role? They tell us what's next. That's why. Like if we know there's a range and there's somehow a mean value that stuff fluctuates back to, then we know, okay, like for example, in this like super simple example, like if 5 is the max that this, whatever this value is, like fluctuates to, and probably after 5 it goes down. And if it's at 2, it probably goes up, right? So that is a very simple concept, but that is why understanding ranges is kind of important, because if we know like there's a mean in anything, like for example, heart rate, and we know, okay, like if someone's just running like extremely fast, like sprinting for 10 minutes, probably you will have a very high heart rate right now, and like once he rests, it will go down again. It will not stay like that for days. So that is the concept, a little bit explained in detail. Now we talk about investing here, and asset prices also fluctuate. And like what the market usually looks at is a price, right? The market usually looks at price, but the price doesn't matter, like as a sole consideration. The important thing is that asset prices fluctuate in valuation ranges. Yeah, like a company is valued today at a P of 10, tomorrow at a P of 15. And that is an important thing, because if the company is some or almost the same today and tomorrow, then there must be somehow an inefficiency, right? And really understanding this can make you a lot of money. And I brought a lot of examples today because it's like kind of nice to actually look at that practically. Before we start to look at these examples, it's important that you find the right pulse. And this is, yeah, can be specific. And I think it's also like something we need to improve over time. But here are a couple of examples. First one, if we look at holding companies, let's say a Berkshire Hathaway. I mean, we could look at the PE and we could compare it to the total market, but probably a better ratio is to look at price to book ratio. Because essentially it's a company that owns other companies. And yeah, if the price to book ratio is like 0.5, then we buy these other companies at half the price. If it's 1.5, we buy it at 1.5 times the price, of 50% overvalued, so to say. But the world might do that because they think that Warren Buffett is great at selecting companies, so the companies that he selects are better than the actual book value in Berkshire's portfolio, right? Then I took also quite some time to look at Reits. Here you can also look at price to book if it's according to IFRS accounting. In the US, you can't really do that because, yeah, real estate is depreciated according to US GAAP. So it's better to look at net asset value to estimate that and see like, okay, is the price higher than the net asset value of the real estate if we look at the real estate value conservatively, or is it lower, right? Then growth companies, we might look at price to sales ratios, price to earnings, or price to earnings and growth. Mature companies, we probably rather look at free cash flow or even dividends, right? So the main point here is that you have to find the right indicator. You might also look at several. But then once you've found the right pulse, you can look at that and you can actually understand what is happening to the company or to the asset right now. And to illustrate that a bit, I brought a couple of examples. I started to talk about Berkshire. What you see here is the price to book ratio from around 2008 to 2022, right? And again, like what the market is looking at is the price, and the price obviously increased a lot. But the price doesn't matter. It only matters like what we actually pay for what we get, essentially. And you see here, like the top is probably like around 2, like definitely over 1.75 of a price to book ratio. So basically around 2008, the market said like, whatever, Warren Buffett is so great and we have so much money, we want to invest so much in the company that we want to pay double of the actual value in the books, right? And then probably the portfolio changed of Berkshire as well. Like I didn't look that much into the details, but interesting is that it then goes down in some years, like to 1. So the market says basically, all right, like we value it at book price to book ratio. And it fluctuates up again to 1.5, right? So theoretically 50% overvalued, like in a very theoretical world. We know it's not that easy, but what you see is that it goes up and down and up and down. And there's somehow a mean value of 1.2 that it somehow always comes back. Right now it's at 1.6. Probably not a great time to buy Berkshire. Another company that I talked with Luke about is Wereld Habe. They're like a little bit of a macerage in Europe. So they are a REIT. And in Europe, real estate is accounted to actual value. So the book value is the net asset value. And yeah, I don't trust auditors 100%, but it somehow has to make halfway sense if they audit this thing, right? So essentially, what we saw here in the COVID crisis, this real estate was valued at like 25% of the net asset value, if you value it according to market comps and so on. I bought that company, I'm up like 30% or something, and that was the main thing I looked at here. They also paid a pretty healthy dividend yield of like 7-8% when it was that low. Obviously, the dividend yield is higher. And that was like a pretty good bet, because if it is at 0.25, like how likely is it that it goes down further, and how likely is that it goes up if you look at like, I mean, that's a quite long time horizon, right? Like that's over 12 years, it's like 14 years, over 14 years. Like ideally we would look back even further, like the longer, the better. But essentially like it's probably a pretty good bet here. If you think that COVID will not destroy the Dutch, like they have most of the real estate in the Netherlands and Luxembourg and stuff. So if you think like the economy will somehow come back, it's probably a pretty good bet. And that's the key indicator you want to look at. Next one is a German medical technology company, medtech company. And here we look at price to free cash flow. They're like somewhat established. So I think it's a great ratio here. Mean is 12.7. And you see here the multiple range is like fucking crazy. It goes like from somewhat below 10 recently to previously 50. So that was a super extreme, but also here, like it came up a few times actually to like over 30, right? There's like 3 times the valuation, and like kind of predictably, or like somewhat in cycles, they're not always the same, but it tends to come back to like over the 30 range. And obviously, like we want to understand why this is, like why is it at the lowest point? But if we find out, like, if we actually somewhat believe in the company and we believe that the market will come back to its early evaluation, then it's also probably a pretty good bet to buy it right now. Other one, Facebook, price to earnings, like simple ratio, mean is 15.9. Also here we want to understand what's actually happening with the company. We want to have a look at a couple of other things, but if we look at these, this pulse, if we just assume it goes back to like the mean before this crash, right, which is probably around like 20 or something, then yeah, it's probably a pretty good buy. And that's part of the reason why I bought some. So overall, we've seen a couple of examples, but I want to illustrate that a little bit more in detail. Like, why is this really so powerful? And the main reason is it helps us to quantify risk reward, right? Like, if we don't use this logic, we estimate risk reward. We say, oh, whatever, like the lowest the price can go from 100 is like 70 because we think that way. And the highest it can go is 150 because of whatever, right? So we come up with like somewhat subjective reasons, and everything regarding the future is always subjective, but we can actually base it way more on data. And I found one amazing analysis from my view that is quite eye-opening. And the presentation is from this guy, Arnold Vandenberg. He runs this fund and this wealth management company. And he provided this presentation, which looks at Schlumberger, an oil company. And he really dissects how to do this very practically and also very mathematically. So let's look at that. Like, he basically uses the same method that I just described. He looks at valuation metrics, enterprise value compared to sales, EBITDA and EBIT, and price compared to several metrics, right? So the logic that he principally uses is the same. What we have now here, it looks like a lot of figures, but I will explain that in detail, and I think it's utterly fascinating. What we look at here is the S&P oil and gas equipment services sub-industry, okay, on a pretty long time horizon from 97 to 2019. And what we then see is the number of days the price was at a certain range. And not the price, sorry, the price to book ratio. The price to book ratio of these companies. So we look at one pulse, so to speak, of companies in the oil sector. And we see that like at 7 days over this long period over decades, the price to book ratio was 7. So like utterly expensive. And 0 days, it was below 1.10, but actually 348 days, it was between 1.1 and 1.7. Yeah, so we know that this historically is pretty low. And that probably if we can buy at this price, it's kind of nice. We also see like the average and the median. Average is around 3. So we actually see like, okay, obviously most of the days it's somewhere around the average, but then there are just some days like where exactly the same or almost the same assets are valued like super low. And then you can obviously argue like oil price fluctuates and so on. But if you also assume that like the oil price always comes back, right? I mean, you've seen it crashing to below 0, comes up again. It's somewhat a fluctuating thing as long as we need oil. Then yeah, it probably just makes sense to buy it at this, like in these 348 days over 20 years. Different ratio, but similar logic, enterprise value to sales. So here you also see like in 858 days, the enterprise value to sales ratio was below 1.2 compared to the highest over 3.45. So same logic, we don't have to go into all the details, but you get the point. Yeah, what you then want to look at as well is like, okay, it's one company, like you want to understand like, does the company underperform right now? Or is the whole sector crashing? Like, and this is what you can do with a chart like this. You look at like the price and you see like here, that is the the commodity price index, and this is the Schlumberger price. So here it was valued higher than the market. Like the market crashed somehow, Schlumberger didn't crash, which basically speaks for a strong company. Here, this also happened, right? But probably if we can then buy it here, it's a good entry point. Yeah, what you then can do is like you look at these ratios and you put them on the price chart. And this is like, I'm not a fan of technical analysis, but I think this makes sense because it's like driven based on valuation, right? And we see like when is the valuation actually high? So we don't really look at the price. We just like want to understand the price chart with valuation ranges. And we see like, okay, here the price is like kind of high. Here the price is kind of low, and the valuation is actually low. Like it's not just the price that drops, it's the valuation that drops. And that's what we are interested in. What this guy then did, and what you can do is you can come up with different scenarios. So WC, which he uses for worst case, is an enterprise value to EBITDA of 7. Sell, like the highest it almost gets, like you see here it's 14.9. So he basically says, sell it before, sell it at 14, right? And buy somewhat around worst case, and FV, fair value, is around 11, right? So he comes up with this, and then probably he looks at this, he sets himself some alarms or something in the system, and then like once he sees, okay, this company is cheap, I'm going to buy it. Because probably at some point it's going to be valued at least at median again. And what this does, like the powerful thing of this, is that you limit your downside very, very well. Because you look at like 2 decades and you say, okay, the worst case is 7. Yeah. And of course things can happen, but no one can really predict the future. But this comes kind of close, right? You see like the actual worst case on a pretty good data foundation. And with that, you then can come to the thing that I promised at the beginning. You can quantify risk reward. Obviously, we know like this valuation stuff is not an exact science, but you can then put these ratios on the price, and you can say, okay, if EBITDA or whatever, whichever valuation metric you look at, is whatever 10, and EBITDA is 3.2, then the price would be 32, right? So that's a pretty simple conclusion then. And you can actually determine your buy prices. You can see how much can it decline. Like here, like less than 20%, that's pretty fine. How much can it increase? Like 70, 80%. So your reward to risk is like from 4 to 8 to 13.5 if you actually buy it at a pretty low price, right? So for me, that was like super fascinating because I've never seen that in this systematic way actually. And it's quite powerful because once you did that for one company and you really understand the company, you can essentially just go and look at the company once a week, once a month, whatever, and say, is it expensive? Is it cheap right now? And then you buy and sell. And this is also the basis how I use it for shorting, right? Like shorting, most people, I think also some of you perceive shorting as quite risky. But if you look at this, like this is for a long example, right? But it's the same if it's at the highest value, the highest valuation it ever was historically. Probably oil is not going to stay high always, and Schlumberger is not going to stay as super highly valued always, right? So to sell it at a 55 with maybe a stop loss at 70, it's not that high risk, right? Statistically, it's not that high risk. The most you lose is 15, and it can go down to 26. Probably it will go down to 26 at a certain point. So you make a 50% profit. And the powerful thing of then long short, to close that thought, is that if you, let's say you have a portfolio of like 5 stocks and your other 4 stocks are long, but you see Schlumberger is at 60 right now, and you make it 20% of your portfolio, then you have a pretty good insurance for your portfolio. Because if the whole market drops, at least Schlumberger goes up, right? And that's oversimplified. And you have to look at the different companies, how they actually behave in a crisis and so on. But that is the idea of long short investing. And that is how you can also do it with pretty limited risk. So that was like pretty much based on single companies. We can also do that for the whole market. We discussed that briefly before. I posted a couple of the graphics, but I want to show it again. And I want to show it a little bit more in detail. So we looked at companies. Now, if we look at the whole market, what's the risk reward of a long only ETF strategy, right? Because if you do a long only ETF strategy and you start investing now, or you invest the majority of your assets right now, it's the same game. You basically bet that over time, companies will produce more profit and it will be at least valued as it is right now. That's your bet with an ETF strategy if you start to invest today. Obviously, it's different if you started to invest 10 years ago. But also for this, we have a pulse. And we have, for example, this Schiller PE, which takes the current price over the earnings of 10 years, right? So one crazy, like one amazing year doesn't really change the whole graphic. It's like kind of reliable because like you cannot have 10 exceptional years, like exceptional in a way that they are like caused by some special factor. Like you actually see the profit of the business and you see the current price. You see that it's currently at 37. It's almost at .com bubble territory and it's way above the mean value. Same for another factor, which is the Buffett indicator, which is the total market cap, not only of the S&P, but of all companies in the US over the GDP. Then you also see that as like that's highest ever recorded basically here, like at least the data that I found. So yeah, based on that, probably doesn't make too much sense to start investing now in ETFs, or if someone does it, probably it makes sense to like limit it a bit. On average, there are other things that play a factor or play a role, and you obviously have to think about like liquidity and how much money is being printed and all of this. Like basically all of this is just money being printed, right, and put into the market. That's what this does. That's where the valuation comes from. And one further thought on this, like, of course, that there can be more money printed, like interest rates can go to zero or lower again. But regarding this pulse, right, and regarding the valuation and prices always going up, all of us inherently have recency bias. And if we don't pay attention to it, it can turn out pretty bad, right? As it did in Japan, which is a perfect example for it, but there's no reason why that shouldn't happen in the West. If you look at the Nikkei index, here, like Japan was praised, right? Was like the US was afraid of the Japanese economic power and so on in this time frame. And yeah, then it totally crashed. So if you would have started here, and then those are like pretty long time horizons, right? Like if you start around like 86 and you invest until 90, like 4 years, you just put some money in a Nikkei ETF, you're still gonna lose money for a long time, like 35 years, you're gonna lose money. So that is interesting to see if you think about like, yeah, a long only and yeah, market-based or index-based strategy. And also like that is a price, but also you see the same kind of pattern if you look at the Schiller PE ratio, which is again, the price over the earnings of 10 years. Like these companies were valued at a PE of 100, right? And here no one, of course, some smart people thought it's overvalued, but obviously the consensus was it's not overvalued. Japan is great, Japan will rule the world and so on. As it is with America right now, right? Right now, the whole world still thinks America is like very reliable. US dollar will remain stable. All of this is priced in the market. But yeah, this can be a bad strategy for like a long time. Like these investors here, they still don't have their money back. Maybe they're like, if they started in 85, they are still somewhat okay. Yeah, but they probably didn't make much money. And if that is their retirement, not so great. Okay, summary. Key points to implement this knowledge. First thing is to understand asset prices fluctuate in ranges. They're not static. And it's not only the price that fluctuates, it's also the valuation range, the metrics, like the actual valuation of the asset. And this also means you can always find mispriced investments, either too expensive or too cheap. The specific point in the range, like it is so powerful because it gives you a probability for a price deal increase. It's no certainty, yeah, but it's a probability. And as we've seen for some companies, if you look at a couple of decades of data, it's kind of reliable, probably the best stuff that you can get. And you can see, is it fairly valued? Is it undervalued? Is it overvalued? Obviously, like this looks rather simple. I think like that most people don't understand this, and they just look at the price or look at other things. They think they like this brand, whatever. They don't look at the somewhat pretty real probabilities that are there in the market. But it obviously is not that easy that you just look at some ranges and then you're gonna have like a 50% return for the next couple of decades. There's more that goes into it. First, consider long time horizons, then consider different metrics. Yeah, maybe there's something special happening with one metric. And then also consider your recency bias and our recency bias that we just have inherently just because something happened. Also in the last 20 years, also for some examples I showed you, it's just 20 years, right? Essentially, we want to understand how stuff developed also over the last hundreds of years to really understand like, okay, like maybe I'm not seeing this kind of event. But yeah, like we definitely want to be aware that the last decades are somewhat extraordinary. Also like the last decades in the overall stock market. And we are at high valuations right now, which is another reason why I think that long short is something pretty important to know for the next couple of decades. Because if it went up for like almost 4 decades, basically every year, probably stuff will go down. And you can obviously select undervalued companies, but it might make sense to also put some short positions in there. Like that is my view on this topic. And that's it. Happy to discuss and take your questions.